Welcome to Retirement Done Right with your hosts, David Rath and Pat Kalish, where we talk about retirement, social security, taxes, estate planning, wealth planning, and more. Now, onto the show.
Is set it and forget it an appropriate strategy for retirees when it comes to their investment portfolio? If you're like me, you remember the guy from late night TV talking about his set it and forget it strategy for rotisserie chicken. Should that also apply to investments? First, let's determine what set it and forget it means when it comes to investing. Typically, you agree upon an initial investment strategy. You utilize some rebalancing along the way, usually at standard intervals like every quarter or every year. And then you resist the urge to make changes based on what the market's doing or based upon some hot stock that somebody told you about. And you stick to that initial strategy. You take the withdrawals along the way that you need. And essentially, you forget about that initial allocation and just let rebalancing and compounding do the work for you. Now, set it and forget it might be somewhat of a misnomer, meaning that you're not literally going to forget that your money exists. However, it does mean that you are going to make less frequent adjustments over time than maybe a more actively managed strategy. So, first, you determine what is an appropriate allocation for your investments, and then you stick to that strategy. You rebalance maybe once a quarter, maybe once a year, but you're not chasing those hot stocks. You're not tinkering with your exposure to US stocks versus international stocks and trying to time the market. So, set it and forget it strategy really refers to the fact that you are agreeing upon what your investment strategy should be from the outset and then sticking to that strategy over time. I'm going to start by making the case for a set it and forget it strategy. Proponents of the strategy will say that it takes emotion out of the equation. You start with that initial investment allocation, you take withdrawals as needed, and then you don't ever check your portfolio. However, in practice, it's a lot harder to implement because humans are hardwired to be pretty terrible investors. What I mean by that is we get greedy when the market goes up, and then we become fearful when the market goes down, leading to some irrational decisions along the way. In fact, there's even a term for this. It's called the behavior gap. This means that the return from any investment, let's say the S&P 500, typically is larger than the average investor's performance in that investment. There was a study ran that said the average investor underperforms the S&P 500 by roughly 3 to 4% every single year. And this is because there is a tendency to buy when things look good and things are going up and sell when things are scary and going down. The second reason why somebody might employ a strategy such as this, they want to enjoy their retirement. Who wants to spend their retirement years watching CNBC, listening to market analysis, poring over the Wall Street Journal? That sounds like a good time for me. However, for people who are retired, who maybe had a different occupation during their working years, that doesn't sound like their cup of tea. Additionally, there are a lot of studies that show that people who tend to check their portfolios less frequently do better than the people who check it very often and end up tinkering with their investments. If you are choosing to employ a set it and forget it strategy, the good news is history tends to be on your side. What I mean by that is dating back to 1928, the S&P 500 has produced a positive return roughly 3 out of every 4 years. Those are pretty good odds. However, as every investment disclaimer commercial will tell you, past performance is no guarantee of future results. You are essentially trusting that the last 100 years of data will continue into the future. Okay, now that we've talked about all the reasons why somebody would just set it and forget it with their investments, let's talk about the counter argument here. And that is a portfolio should be actively managed, actively adjusted over time. Now, keep in mind that I am definitely biased in this situation because we do manage our clients' money according to a lot of the things that we talk about coming up. The first argument for being more active within an investment strategy is that change is inevitable. Think about 30 years ago, what was going on not only with your personal financial situation, your family situation, but also the world at large. Things are much different today, and adjustments should have been made along the way to account for that. To that last point, market dynamics are consistently changing. Yes, it makes sense to invest in stocks over the long run based upon some data that we talked about before. However, there are periods of time, very long periods of time, where you will second guess yourself. From the end of the bull market in the year 2000 until about 2010, the S&P 500 actually had a negative return over that 10-year period. It's easy to look back and say, of course, I would have held on during that time period. I would have actually bought more as the market went down. However, in real time, it's much harder to implement those types of strategies. Or how about a period of time where nothing is really working? The 1970s as a decade was defined by high inflation, multiple bear markets within the stock market, and bond investors getting crushed because inflation dictated that interest rates were going up to counteract them. And that brings me to my next point. The sequence of return risks is a very real risk for retirees. A retiree who retires during a bull market has a much different experience than one who retires during a period of time where the stock market is down 30-40%. Having an active strategy to navigate those types of market environments, in addition to adjusting your withdrawal strategies, is essential when things start to go south. The final point that I'll make in the case against set it and forget it is the fact that the chances that you got everything right from the outset are probably pretty small. There are a lot of decisions that go into constructing an investment portfolio. First, how many stocks should you have versus the bonds? What should your allocation be to US stocks versus international stocks? Should you include emerging markets? Should you include alternative investments? Proponents of buy and hold will tell you that you just allocate to stocks and bonds and the allocation will take care of itself. However, over time, you're going to be second guessing those changes, which can lead to you making changes, which can completely defeat the purpose of the initial strategy. So which is it? Yes or no? Should you or should you not utilize a set it and forget it strategy with your retirement investments? I will fully acknowledge the fact that I'm biased in this situation because we actively manage our clients' portfolios to account for all the changes that we just discussed. Can set it and forget it work for retirees? Absolutely. However, the best investment strategy is one that's adhered to over a long period of time. Passive investing, like set it and forget it, flies in the face of basic human tendencies to fret, to adjust, to monitor all of the things that we just spoke about. Our job is to shoulder the burden of investing so our clients can enjoy retirement, knowing that they have a co-pilot helping them to navigate the uncertain waters that are the stock market and the tax code. After all, they worked really hard to get to the retirement years. Your investment strategy should give you peace of mind, not anxiety.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.